stocks holding on to gains here as we are just about an hour into the trading day, continuing to bounce back from that 3-day global sell-off. But to understand the relief that you're seeing on your screen right now, you got to understand all the factors that came together to drive the original sell-off we saw. So let's dive in with the first big driver, the unwind of the so-called carry trade. Now, as a reminder, that is when investors borrow at a lower cost from one currency, in this case the yen, to invest in a higher yielding currency. In this case, that was the dollar. So let's jump back to last Wednesday. That is when the Bank of Japan initiated its largest rate increase since 2007. That sent the Japanese yen to a 4-month high against the dollar. Meantime, the dollar weakened as the Fed opened the door to rate cuts here in the U.S. That led to an unwind of a popular carry trade. So then we got our second sell-off driver here, which came in the form of jobs data. Initial jobless claims came in softer than expected on Thursday, and the unemployment rate drove above 4.3% on Friday. That triggered a key recession indicator that's called the Sahm rule. Now, the unwind of the carry trade, the labor market data, and concerns about a growth scare, that all came together, culminating in the worst day for the S&P 500 in almost 2 years on Monday. Heading into today, overnight, we woke up to news that the Bank of Japan blinked. The Deputy Governor Yoshida said they would not raise rates while markets continue to be unstable. And that is what is primarily driving the market gains that we are seeing today. So that's a look at the last week of history that got us here. But what moment in history compares with one as whipsawing as we have seen here? Joining us to discuss exactly that, we've got Peter Oppenheimer. He is the Global Chief Equity Strategist at Goldman Sachs. Peter, it's great to speak with you. And honestly, you were the one person I really wanted to talk with over the course of the past couple of days because you are so good at understanding and giving context about market history. So how does the moment that we are experiencing right now compare with other moments that you've seen in terms of sell-offs, in terms of carry trades unwinding? What does this remind you of?
Well, thanks for having me on, and I appreciate it. I would say, first of all, it's important to think about the context here of what came before this correction. You know, we have had a very strong run-up in equity markets. It really started last October as investors started to get more confident that a recession could be avoided after a couple of years of rising rates. And they also got more confident that inflation and interest rates were coming down. And from that point up until last week or two, global equities had run up by about 30%. The NASDAQ, which had had the additional support of big tech stocks, was up over 50%. So you'd seen this very, very strong rise, a lot of complacency being priced in, high valuations. And it wouldn't really have needed much disappointment, I think, to trigger a correction. And you very well described the proximate factors that triggered that. Now, actually, the correction was relatively constrained. I mean, it's not very untypical to have a fall of around 10%. The S&P was slightly lower than that, actually. It's just that it happened very, very quickly. And I think largely as a function of the carry trade unwind that you mentioned just earlier on. What I would say, though, is that there is still a lot of concentration in markets, particularly in the US, and high valuations. So in the next few days, it's still going to be very, very dependent, I think, on any further data we get on earnings and the macroeconomy to really reinforce the stability that we're seeing today.
So Peter, two-part question here. I'm asking them both at the same time because they're a bit related. So I guess with that in mind, with what you just said, should we then be prepared for another dramatic sell-off, or maybe not to the extent of Monday, but more volatility given that uncertainty? And then when you look at what happened, should we be viewing that, given the fact that you were just talking about that it had been so long since we had seen that 5% pullback, and the list goes on, is what we've seen play out here over the last 5 or 6 trading days, should that be viewed as healthy then for the market?
I think healthy, again, importantly, in the context of what we've seen in the 6 to 9 months before it. You know, very, very strong rise in equity markets globally, particularly in the US, with very low volatility. So some pullback after that kind of backdrop, I think probably is quite healthy. It's flushed out some of the very concentrated exposure in things like the yen carry trade, and also very strong ownership of some of the biggest tech stocks, some of which have seen some more risk being priced in about the realistic timing of the future returns we're going to see. I think all of that is pretty healthy. It's important, I think, also to say that once you've had a correction of this scale, typically equities do recover as long as you don't get a recession that follows. Now, the concern that was triggered last week with the jobs data in the US made investors a little bit slightly more worried that you might see a recession. But our own view, and the economists at Goldman Sachs, think that a recession is still not very likely. They put it at about a 25% probability in the US over the next year. What we do know is that interest rates are beginning to come down around the world, and that's likely to begin to happen as well in the US relatively soon. So with this kind of correction, I think, yes, we'll probably get some near-term volatility as confidence begins to rebuild. But for those taking a more medium-term view, as long as we avoid a recession and interest rates come down, this is probably quite a good buying opportunity.